Hello everyone, welcome back to my channel, The Learning Path. This is Dr. B. Meena, Associate Professor and Research Supervisor from Petition College of Arts and Science. In this video, I'm going to teach you how to calculate the payback period if the annual cash flow is varying between the years. In the previous video, I told you the meaning of payback period. Kindly check out the previous video to know the meaning of payback period. And the format of knowing the cash inflow or profits after tax and before depreciation is same. But in case the annual cash inflow is not same for all the years, it is varying between the years, means we need to work out this kind of format, how to calculate the annual cash inflows for each and every year. So the content is common. The particulars content is common. That is profit before tax and depreciation. From that, we need to deduct the depreciation. How to calculate the depreciation? The project cost divided by number of years. Then we'll get the answer. The answer name is called as what it is. Profit before tax and after depreciation. Then from that, we need to deduct the taxation. Then we'll get what is the profit after tax as well as after depreciation. But the annual cash inflows must be inclusive of depreciation. That is why we are adding the depreciation again. And that is the thing I explained in the previous video. This is the format which is common to all the methods how to calculate the annual cash inflows. So in case the cash inflow is not constant for all the years, we need to work out separately what is the annual cash inflows for each and every year like this. Once you know the annual cash inflows, then we need to work out the cumulative cash inflows of all the years. So because the formula to calculate the payback period, in case annual cash inflow is varying, means the formula is completed years plus proportionate years. In case the annual cash inflow is constant, means I told you the formula to calculate the payback period is the investment divided by annual cash inflow. That is in case of when annual cash inflow is constant. But when the annual cash inflow is varying, payback period is equal to completed years plus proportionate years. So once you know the cash inflows of each and every year, you need to work out the cumulative cash inflows. Then we will work out the payback period by using this formula. Let me check the problems in the next slide to know more understanding on this. Calculate the payback period for a project which requires a cash outlay of 1 lakh. The investment value is 1 lakh. And generate cash inflows of rupees 25,000, 35,000, 30,000, 25,000 in first, second, third, and fourth years. So this is an example of a problem where the annual cash inflows are varying. At that time, we need to work out the cumulative cash inflows, then make use of the formula to calculate the payback period. Here the cash inflows are given in the problem itself. The only work we need to work out the cumulative cash inflows. So the first year, 25,000 is the cash inflow. So cumulative can be also 25,000. But the second year, 35,000 is the cash inflow. So the cumulative must be first year 25,000, second year 35,000. So the sum you will get 60,000. Likewise, the third year, this 60,000 plus the 30,000 cash inflow. So 90,000. Fourth year, 90,000 plus 25,000, I'll get 1,50,000. So this is the way how you will calculate the cumulative cash inflows. So we need to calculate cumulative cash inflows in case the annual cash inflows are varying between years. So once you calculate the cumulative cash inflows, we check out what is the investment that people are making. That is 1 lakh as per this problem. So 1 lakh is the investment, right? So look at the cumulative cash inflow column, the third year. The third year itself, I'm getting 90,000 out of 1 lakh. Am I right? Again, I'm repeating. The investment is 1 lakh. The investment Within the third year, I'm able to get it back 90,000 out of 1 lakh. Only the 10,000 I'm going to get it in the fourth year. So again, I'm repeating, 1 lakh is the investment. The cumulative cash inflows will clearly tells you in the third year, within the third year, you will get 90,000 out of 1 lakh. The remaining 10,000, you can take it back in the year, that is fourth year. So how to calculate the payback period? Completed years. So 90,000 I'm getting in the third year. So 3 years plus what is the remaining balance out of 1 lakh? So 1 lakh minus 90,000, 10,000. So 10,000 divided by what is the fourth year respective cash inflow? 25,000. So 1 lakh is the investment. 90,000 I'm able to get it in the third year till I need 10,000. That 10,000 divided by what is the fourth year cash inflow? 25,000. So 10,000 divided by 25,000. 0.4. So 3 years plus 0.4, I'll get the answer as payback period 3.4 years. That means the investment 1 lakh, excuse me, you will get it in within 3.4 years. So this problem will clearly explains you in case cash inflows are varying between the years, how to calculate the payback period. And cash inflows were given in the problem. Let me check one more problem. So we have a company as an investment opportunity costing rupees 40,000. So investment is 40. So we have the cash inflows for 7 years. So the question is determine payback period. So just like the previous problem, what I discussed now, I just calculate the cumulative cash inflows and then the investment is 40,000. Okay. So there's 40,000 lying between which year? Fifth and sixth year. The investment of 40,000 is lying between fifth and sixth year. So fifth year 39,000. So remaining one more thousand only I need to get it in the sixth year. So 5 years plus 1,000 divided by what is the respective sixth year cash inflow? 9,000. So 1,000 divided by 9,000, I'll get 0.11. So 5 years plus 0.11, I'll get 5.11 years. So I hope you will able to understand what I'm trying to make you to understand. That is, in case annual cash inflows are given in the question, which is varying between the years, then how to calculate the payback period? We need to work out the cumulative cash inflows. Then we are able to compare where the investment is lying between, in which year. Say, for example, this problem, the investment was made 40,000. So that investment is lying between fifth and sixth year. So that is 39,000 I'm able to recover in the fifth year itself. Only 1,000 I will get it from the next year. So I need to work out the proportion. 1,000 divided by what is this sixth year cash inflow? 9,000. So 1,000 divided by how I got 1,000? 40,000 minus 39,000, 1,000. So the 9,000 it's simply the sixth year cash inflow. So 9,000, 1,000 divided by 9,000 if I am doing means 0.11. So 5 years plus 0.11 I'll get 5.11 years. Let me check one more problem. Future Limited is considering two projects. Each requires an investment of 10,000. The firm cost of capital is 10%. The net cash inflows from investment in two projects A and B are as follows. So we have cash inflows for both project A and project B. And then the project investment cost is 10,000. The cost of capital is 10%. The company has fixed 3 years payback period as the cutoff point. State which project should be accepted. So look at the solution. I have a year column, project A. Under project A, cash inflows and cumulative cash inflows, and a project B, cash inflows and cumulative cash inflows. So I just write what are the cash inflows from first year to sixth year for project A. Then simultaneously I calculated what are the cumulative cash inflows. Likewise, I calculated cumulative cash inflows for project B after writing the cash inflows of project B. Then whenever you have the information about the cost of capital, try to ignore the cost of capital in calculating payback period. Now look at that. Investment 10,000 is lying between. Investment 10,000 is lying between second year and third year. Just look at the previous slide. For both the project, investment cost is 10,000. So where it is, lies in the project A? So it is in the second and third year. It is in second and third year. The second itself, I got it 9,000. So only one more thousand that I get it from third year. So 1,000 divided by 3,000, because the third year 1,000, the third year annual cash inflows is 3,000. So 1,000 divided by 3,000. Likewise, in the project B column, where I am getting 10,000 exactly fourth year, exactly fourth year. Just look at the next slide. So 2 years, 1,000 divided by 3,000, I said no. So 2 years, 1,000 divided by 3,000, 0.33. So 2.33 years is the payback period for in case of project A. In case of project B, the exact 10,000 investment lying on the fourth year, I said. So 4 years is the payback period for project B. So project A is only preferable because of its shorter payback period. So I hope you understand how to calculate the payback period in case annual cash inflows are varying, then how to calculate the cumulative cash inflows, and how we will trace out where the investment is exactly lying to calculate the payback period by using the formula. What is the formula I mentioned? Completed years plus proportionate years. So this is the way how you will calculate the payback period where annual cash inflows are varying. Thanks for watching my video. Click the bell button to subscribe my channel. Like and share my videos to your known contacts. We will catch up in the next video. Until then, bye-bye.